Welcome to Master Trader, where you learn simple market analysis to make money investing and trading in the markets. I'm Dan Gibby, Chief Options Strategist, and with earnings season upon us, I wanted to do this lesson on the risks of shorting options into earnings. And as you're going to see, why I refer to this as, are you feeling lucky? Because you have a significant gap risk. A short straddle is when you sell calls and puts at the same strike and expiration. This is the risk profile, risk graph of a short straddle. So the total premium that you take in is your maximum gain, and your break-evens, I'm going to show you with three examples here, these strategies, but you have two break-even points, whether the stock goes up or down. A short strangle is similar to the short straddle, except for both strike prices are out of the money. So you're going to make your maximum gain as long as it expires within those two strike prices. Your max gain on any time you sell options is the net credit you receive. The max loss on these two strategies are unlimited, and that's because of the short call. So if the stock continues to rise in both of these situations, you can see that your loss is getting greater. Option traders trade this strategy on the belief that they think the options are overpriced, and they think that the stock's actual move will be less than the premium that they receive. This whole strategy boils down to whether you're going to buy options and a straddle or a strangle, or short them into earnings. It 100% is based on your belief of how big or small of a move you predict relative to what the market is predicting. SKX here. The stock closed right at 42 bucks. So a straddle, we're going to sell a 42 call and a 42 put, and this just had 1 day to expiration. So into the close on Thursday. Here's my order entry, selling the call and the put, and the midpoint was $4.62 a share. This little square right here is the implied volatility of these options, and in the parentheses is what the option prices are implying as the expected move by expiration. And what's interesting here, I mentioned here, you're taking in 462, which is greater than the expected move. Your two break-even points at expiration is you add the 427 to the short call, and that's 46.27, and then you subtract the 427 a share from your 42 put, and that gives you 37.73. Expiring $30.70. If you held it to expiration, that would have been over a $7 loss per share. How do you calculate that? Well, it's your lower break even, $37.73, minus where it closed, because you're obligated to buy the stock at $42, but you put $4.27 in your pocket. Now it's worth this. Philip Morris. The stock closed at 101.89. So in this one, we're going to do a strangle, which is selling an out-of-the-money call and an out-of-the-money put. So here we sold the 102 and bought and sold the 101 put. Here's my order entry, $2.64 a share. Your break-evens here, same math as before. You take the 102 and you add the 264, and then you take the 101 and subtract the 264. If you also held this one to expiration, then you would have lost a whopping $14 a share. Third example, IBM closed at 160.91, so we're going to short the 160 out of the money puts, and the next strike that was available was 162.5. This will be a 3 days to expiration. We're taking in $6 a share. But again, the expected move is $7.15. If you held this one to expiration, you lost over $9 a share. Your lower break even minus where the stock closed. For those of you wanting to build on your investing and trading knowledge in the financial markets, you should check out our Master Trader weekly lessons for investors and traders. Each lesson, it's an incredible lesson on trading stocks or options. You're going to get advanced chart analysis, professional mindset for the proper psychology and risk management, and much more. Each one of these can change your financial future, and it's less than $12 a month. Hope that helped. Please don't forget to subscribe to our channel at YouTube. Happy trading, be careful in earnings season, and see you next time.